Silver is no longer reacting, it is absorbing. After weeks of violent price discovery, the market has entered a phase that is far quieter on the surface and far more consequential underneath. Prices are holding within a defined band, roughly between $70 and $80, and that stability has led many observers to assume the market has normalized. That assumption is premature. What silver is doing now is not resting, it is recalibrating. The events that pushed silver into this range were not incremental, they were extreme. A historic rally driven by momentum, leverage, and narrative conviction pushed prices to levels that outpaced both fundamentals and liquidity. When the reversal arrived, it was mechanical rather than emotional. Margin requirements rose, futures positions were reduced, ETF flows reversed, and risk systems did exactly what they were designed to do. Capital stepped back, price collapsed. What followed was not a recovery but a pause. That pause is where silver sits today. Markets rarely move directly from excess into clarity. They move from excess into uncertainty. In this stage, participants stop asking how far price can go and start asking whether the market itself has changed. That question is now being asked quietly across institutional desks. The absence of aggressive buying is not bearish by default. The absence of aggressive selling is not bullish either. Together, they signal a market that is reassessing its internal balance. The $70 to $80 range is important because it represents the first area where conviction broke during the rally and where forced liquidation slowed during the collapse. In other words, it is where belief gave way to risk management. When price returns to such zones, the market is effectively replaying its own decision-making process. Buyers are testing whether value exists. Sellers are testing whether fear remains. The outcome of that test determines the next regime. From a macro perspective, silver is no longer being carried by a single dominant force. Dollar strength has stabilized but not reversed. Bond yields remain elevated but are no longer accelerating. Central bank expectations have cooled, removing a key speculative tailwind without introducing an outright headwind. In this environment, silver is no longer reacting to headlines. It is reacting to structure. Structure matters most when volatility compresses after expansion. This is the phase where false confidence is most dangerous because nothing appears urgent. Yet, historically, this is when markets decide direction. Range-bound behavior is not neutrality, it is tension without release. For professionals and researchers, this is the phase worth studying, not because it offers easy conclusions, but because it reveals how capital behaves when certainty disappears. Silver is not broken, it is not confirmed, it is unresolved, and unresolved markets do not stay that way indefinitely. What distinguishes this phase from a simple consolidation is the behavior of participation. During the rally, participation was broad and aggressive. During the collapse, participation was forced and defensive. In the current range, participation has become selective. Volume has declined relative to the extremes, but it has not disappeared. Instead, it has become concentrated around the edges of the range, where decisions matter most. This shift tells us something important. The market is no longer being driven by momentum traders. It is being shaped by risk-aware capital. Institutional participants tend to engage differently in post-dislocation environments. Rather than committing directional capital, they probe, they scale. They observe how price responds to stress rather than how far it can run. In silver's case, repeated tests toward the lower end of the range have not produced panic, but they have not produced enthusiasm either. That balance suggests that forced selling has largely passed, but discretionary buying remains restrained. ETF behavior reinforces this interpretation. The violent outflows that accompanied the crash have slowed. Inflows, when they appear, are smaller and shorter-lived. This pattern reflects a market that has shifted from conviction to evaluation. Capital is no longer chasing upside narratives, but it is also no longer rushing for the exit. For longer horizon participants, that neutrality is information-rich. It implies that price is no longer being dictated by urgency, but by relative value assessments under uncertain conditions. Another important signal comes from volatility itself. Implied and realized volatility surged during the collapse as expected. What matters now is that volatility has begun to compress, but only partially. It remains elevated relative to long-term averages. This combination is significant. It suggests that the market expects resolution, but does not yet agree on direction. In academic terms, this is a state of unstable equilibrium. Small changes in external conditions can produce outsized responses. Silver's position within the broader macro landscape adds to this fragility. Unlike gold, which benefits from clear reserve asset demand, silver remains sensitive to both monetary and growth narratives. That dual identity becomes problematic when macro signals conflict. Inflation data may suggest persistence, while growth indicators soften. Risk sentiment may stabilize in equities, while credit conditions tighten. Silver absorbs these contradictions directly, which is why its price behavior often looks confused before it becomes decisive. Relative performance also offers insight. The gold-silver ratio has widened since the peak, indicating a preference for safety over leverage. That does not imply abandonment of silver, but it does suggest caution. Historically, sustained periods of silver underperformance tend to coincide with uncertainty rather than outright risk-off environments. That is consistent with the current range-bound behavior. The key point is this: silver is not waiting for permission to move. It is waiting for alignment. Alignment between macro conditions, positioning, and sentiment. When that alignment appears, the resolution tends to be swift. Until then, the range persists not as indecision but as preparation. What ultimately breaks a range like this is not time but imbalance. Ranges persist as long as opposing forces remain proportionate. They resolve when one side exhausts itself or when an external variable disrupts that balance. In silver's case, the most likely sources of disruption are not internal to the metal itself, but external to it. The first of those variables is liquidity. Silver's historic rally was not driven by physical scarcity alone. It was driven by abundant liquidity interacting with leverage and narrative momentum. When liquidity conditions tightened, the reversal was immediate. Today, liquidity is neither expanding nor contracting aggressively. That neutrality is deceptive. Markets do not require extreme liquidity shifts to move. They require marginal change. A modest reacceleration or withdrawal of liquidity can be sufficient to tip a balanced market. The second variable is expectations around monetary policy. Silver is highly sensitive not to policy decisions themselves, but to changes in expectations. When the market believes easing is imminent, silver tends to front-run that belief. When that belief is questioned, silver reprices quickly. At present, expectations are cautious and fragmented. That fragmentation supports range-bound behavior. A consensus shift, even without an actual policy change, would likely break the range. The third variable is risk transmission from outside the metals complex. Silver often acts as a conduit rather than a destination. Stress in equities, credit, or currencies does not always flow directly into silver as safe haven demand. Sometimes it flows out of silver as capital seeks clarity elsewhere. This is why silver's response to broader market stress can appear inconsistent. What matters is not the presence of stress, but where capital believes stability exists. It is also important to address what is not driving the market right now. Physical supply constraints, long-term industrial demand, and structural deficits are frequently cited, and they remain relevant over long horizons. But they are not the marginal drivers of price at this stage. Futures markets, ETFs, and macro hedging flows dominate near-term behavior. Ignoring that reality leads to misinterpretation. From a behavioral standpoint, the current range is doing something subtle. It is resetting reference points. Traders who anchored to the highs are gradually disengaging. Those who anchored to the lows are reassessing risk. Over time, this reduces emotional bias and replaces it with conditional participation. That transition is often a prerequisite for sustainable moves in either direction. If silver breaks higher from this range, it will not be because optimism returned. It will be because uncertainty resolved in favor of alignment. If it breaks lower, it will not be because fundamentals failed. It will be because patience did. Both outcomes are consistent with the current structure. At this stage, it becomes useful to distinguish between stabilization and compression. Stabilization implies that the market has found acceptance, that buyers and sellers are comfortable transacting within a known range. Compression implies something else entirely, It implies that participation is thinning, that conviction is declining, and that price is being held in place not by agreement, but by hesitation. Silver's current behavior aligns more closely with compression than with comfort. One way this reveals itself is through the quality of rebounds. Moves off the lower end of the range have been reactive rather than assertive. They occur quickly, often on reduced volume, and stall before reclaiming prior momentum. This suggests short-term positioning adjustments rather than long-term capital commitment. Similarly, pullbacks from the upper end of the range lack urgency. Sellers are present, but they are not pressing. They are responding, not initiating. This is characteristic of a market in balance, but not in equilibrium. For institutional observers, this distinction matters. Markets that stabilize tend to advertise their stability. Volatility declines decisively, correlations normalize, and narrative attention fades. Markets that compress do the opposite. Volatility remains elevated relative to history, correlations remain unstable, and attention oscillates between disinterest and concern. Silver is firmly in the latter category. Another signal worth noting is how silver reacts to information. In trending markets, data reinforces direction. In compressing markets, data is absorbed asymmetrically. Recent economic releases have produced muted, short-lived reactions rather than sustained moves. This does not mean the data is irrelevant. It means the market is waiting for data that changes expectations, not confirms them. That distinction is critical for interpreting near-term price behavior. From a structural standpoint, compression increases the probability of discontinuity. When price is held in place by indecision rather than conviction, resolution tends to be abrupt. This is not a forecast. It is an observation grounded in market mechanics. Liquidity thins as participants wait. When a catalyst appears, fewer orders are available to absorb the move. The result is acceleration. Importantly, compression does not favor one direction over another. It favors magnitude. The longer silver remains confined within this band, the more significant the eventual move is likely to be, regardless of direction. That is why professionals focus less on predicting outcomes and more on identifying when conditions are changing. What should be watched now is not price itself, but behavior around price. Does volatility expand on advances or declines? Does volume confirm breaks or fade them? Does silver begin to move independently of gold, or does correlation tighten further? These are the questions that precede resolution. Silver is not resting, it is coiling. What makes this moment consequential is not that silver must move next, but that it cannot remain unresolved indefinitely. Compression phases end not when the market becomes impatient, but when information, liquidity, or expectation shifts enough to break proportionality. That shift rarely announces itself loudly. It tends to emerge quietly, then express itself decisively. If stabilization ultimately gives way to acceptance, silver may continue to trade within or only slightly beyond the current range, while volatility declines further. In that outcome, the market would be signaling that the excesses of the prior cycle have been absorbed and that participants are comfortable re-engaging at these levels. Such a phase would not be dramatic, but it would be constructive. It would imply that future moves, when they arrive, are more likely to be durable rather than reflexive. If, however, compression resolves to the downside, the implication would not necessarily be structural weakness in silver itself, but rather a failure of alignment. A renewed tightening in financial conditions, a material strengthening of the dollar, or a broad reduction in risk tolerance could overwhelm residual demand. In that case, price would move not because sellers are aggressive, but because buyers step aside. History shows that such moves can be sharp, but also that they often exhaust quickly once repositioning is complete. A third outcome remains equally plausible. Compression may resolve upward if macro expectations shift in a way that reintroduces alignment between silver's monetary and industrial narratives. That alignment does not require optimism. It requires coherence. When uncertainty resolves into a dominant framework, capital tends to respond rapidly. In such cases, the first move is often not the most important. What matters is whether follow-through emerges as volatility expands rather than contracts. Across all scenarios, one principle remains consistent. Markets do not transition cleanly from disorder to clarity. They pass through ambiguity first. Silver is firmly in that phase now. The range between $70 and $80 is not a resting place. It is a diagnostic space. How price behaves here tells us far more about future risk than any single data point or forecast. For professionals, academics, and researchers, the value of this period lies in observation rather than conclusion. Watch how capital responds to uncertainty. Watch whether liquidity returns gradually or abruptly. Watch whether volatility resolves directionally or dissipates. These signals precede outcomes. Silver's past volatility captured attention. Its present behavior demands interpretation. What follows will not be defined by excitement but by structure, and structure, once it shifts, tends to do so with little warning. If this analysis aligns with how you study markets and value disciplined, institutional perspectives over reactionary narratives, staying engaged with future discussions like this may be worthwhile. Periods of compression are where understanding is built, even if clarity arrives later. This is not the end of the silver story. It is the point where the next chapter becomes possible.